Hi, I'm Richard Murphy, and this is the 18th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we're exploring the importance of corporation tax in any tax system. Corporation tax plays a vital role in the tax systems of many lower income countries, often raising considerably more tax revenue as a proportion of total tax income, usually 20% or more, than is the case in higher income countries, where it is normally only 10%. That means any tax transparency system has to pay particular attention to this tax. At a rather basic but very important level, it can be important to explain why a country requires a corporation tax. The reasons are, firstly, that companies are owned by individuals, but who they are can be hard to determine. So corporation tax is required to make sure that tax is collected. In this way, corporation tax acts as an anti-avoidance mechanism. Secondly, a company may be located in a place, but the owners may not be. So it is appropriate to charge the company to tax where it operates, so that tax is paid there. Thirdly, companies may not pay any returns by way of dividends to their shareholders for long periods, even if they are profitable. So relying on tax from that source to tax corporate profits would be very costly and involve long delays in collecting taxes. Fourthly, companies do actually have an economic substance. They have their own legal identity. They can survive their owners, for example, and as such, they should be taxed as they do actually engage in economic activity. They're not just agents for their owners. They are the principals in economic transactions. These reasons to tax companies are threatened by some of the actions that companies facilitate. For example, firstly, companies can be used to relocate where profits are recorded, a considerable cost to the countries where they should be declared. Secondly, companies can be used to facilitate tax evasion unless strenuous efforts are made to ensure that companies are properly regulated and their accounts are placed on public record. Thirdly, poor accounting standards can be used to underreport profits subject to taxation. It is important to understand that the issues surrounding corporation tax are different depending on whether companies are large or small, a company trades or not, those companies are domestically owned or not, companies trade solely within a jurisdiction or not, companies are parts of a group of companies or not. There is a universal requirement, however, whatever the side, trading, status or ownership of an entity might be, that details of the following should be on a company register maintained by the government of a jurisdiction. The company's name, the company's number, the company's constitution, the name of its directors and details of how they might be contacted, the periodic financial statements of the entity prepared for the benefit of its shareholders, and the names of its major shareholders, anyone owning more than 10% of the shares alone or with others. Only with this data being available is it ever going to be possible to effectively trace the operations of companies in a jurisdiction. And this data is, as a result, a core part of tax transparency with regard to corporation tax. To ensure that the activities of companies operating in a jurisdiction can be identified, it is also vital that automatic information exchange between banks and the tax authority of the jurisdiction must take place, not just internationally, but also domestically. In addition to the existing international conventions under OECD standards, which are adequate for this purpose, the domestic need for automatic information exchange requires that data be exchanged on, firstly, the identity of the companies that the bank supplies services to. Secondly, who they think its directors are, and thirdly, where precisely it trades. In addition, what sums in total were deposited in each of the company's bank accounts during the year excluding transfers between accounts under common control, should be identified. With this data, it is likely that a domestic tax authority will have all the information it needs to identify the companies likely to be owing tax in its jurisdiction, whether locally owned or not. What all the points previously made make clear is that, firstly, corporation tax policy must feature prominently in a jurisdiction's tax strategy. Secondly, corporate transparency policy should be prioritized in that tax strategy. Thirdly, that the necessary resources are provided to the jurisdiction's corporate registry to ensure that it policies the operations of all companies in existence in that place, with appropriate charges being levied on those companies to fund this activity if that is thought to be appropriate. Similarly, the tax authority of the jurisdiction must be properly funded to undertake their work on corporation tax. This allocation of funding must be disclosed as part of the budget processes as noted in previous modules. All the above having been noted, it is important to highlight the particular problems that arise with regard to the operations of multinational corporations that are owned outside a jurisdiction but which have trade within it. The biggest problems arising from multinational companies trading in a jurisdiction are identifying them, ensuring that their profits are correctly declared, resolving tax disputes. 20 years ago, most of these problems were insurmountable for many jurisdictions, but now they are not, largely because of the OECD's Base Erosion and Profit Shifting program, launched in 2015, in the development of which I was heavily involved. In particular, automatic information exchange now helps considerably with the identification of companies trading in or related to a jurisdiction, even when located outside it. Country-by-country reporting, which I first created, also provides data to jurisdictions that can access this information on the trading of multinational companies in all the places in which they operate, so that using a series of quite straightforward calculations, it can be determined whether it is likely that appropriate profits have been declared by the multinational corporation in the jurisdiction. If the tax authority is funded to use data from these two sources, it is likely that significant steps to tackle tax abuse from profit shifting can be made. This is especially true with regard to transfer pricing abuse. In that case, the length and cost of tax disputes with multinational corporations should be reduced. For the sake of tax morale within the jurisdiction, it is vital that it is known that these measures are being used to monitor the activities of multinational corporations. The willingness of domestic taxpayers to settle liabilities owing will be reduced if it is known that multinational corporations are abusing a jurisdiction. Publicity on this issue is vital as a result. A particular problem with multinational corporations arises when incentives are given for foreign direct investment. As far as possible, special arrangements for foreign direct investment into a jurisdiction should be avoided. But when they are provided, for example, via enterprise zones and free ports, the justification for policy on this issue and the associated costs must be included in a tax strategy and a budget. It is also important to remember that corporation tax is charged on corporate profits. It is vital, therefore, that strong and appropriate accounting standards are in use in the jurisdiction. Whilst international financial reporting standards are useful for ensuring quality, locally produced standards may be appropriate if they meet local needs and are backed by law. Specialist expertise might need to be brought in on occasions to support the government on the delivery of these standards. It is also vital that tax officials have a thorough understanding of these accounting rules if a corporation tax is to be operated properly. Extensive training might be required. And it is vital that good relations are maintained with the accounting profession and lawyers in the jurisdiction, even if there is not always a meeting of the minds on all issues. Openness and transparency is a key part of building those relationships, which are essential if a tax system is to work, especially with regard to corporation tax. but care about over-familiarity is essential. It is also important to note that corporation tax is not the only tax paid by companies. All other taxes are likely to impact in some way with the operation of a company, especially if it is large enough to be VAT registered and operate PAYE on salary payments to employees. This makes the observations on maintaining good corporate registries especially important. If they are not, then losses from tax evasion are likely to arise with regard to these other taxes. Finally, the government of a jurisdiction needs to be clear as to its tax policy on setting corporation tax rates, the rates of allowances and relief available to companies, and how to exempt companies with low income from tax if that is thought to be appropriate, which might not be the case. In summary, corporation taxes are vital, but they can only work well if there is a significant tax transparency and public engagement around their operation.